Inflation hit another 40-year high last month at a 7.9% annual rate. And that was before the big spike in gasoline prices over the past 2 weeks. Where is inflation heading now, and how can the Fed tackle it? Joining me now, Andy Kapyrin, Co-Chief Investment Officer at RegentAtlantic, a top Barron's-ranked advisory firm. Andy, thank you so much for coming on the show. We really appreciate it. So look, we've all seen the price at the pump, the inflation prints, the prices at the groceries. And I got to give you guys credit because I think it was over a year ago I spoke to your colleague, Chris Cordero, who was warning about inflation. You were setting clients up for that. Okay, here we are. How long does it last?
So that's the scary part, is what's happened over the past few weeks is making this something that's going to have some staying power, is going to last it a little bit longer. I'd say at this point, inflation is likely to peak in April or May as all the pass-through from higher gasoline prices makes its way in. But core inflation is going to stay high. Look at what's happening to rents. Rents are running at some of the highest levels in a generation. Something like that takes a while to work its way through. Inflation is going to stay with us for at least a couple more years.
Ouch. And it's global. I mean, Japan just had, I think, a 9% print. Okay, so now the Fed has got to attack this. How high do rates need to go?
Sure. So if you ask the typical market participant, they think rates are going to top out somewhere in the 2 to 2.5% range. That's where we were in 2018 before the Fed started to cut interest rates again. I would argue that the Fed's going to need to hike rates even higher than that to have a material impact on rising prices. It's going to take it at least a year and a half to get there. So there's a lot of visibility and some time for us to see this through. But interest rates could rise to 3% or more before this is all said and done.
Andy, is that going to hurt the stock market if rates rise like that? Does it depend on whether we go into a recession? What should stock investors be thinking?
Sure. So it's very rare to have a bear market without a recession. And that's actually good news because the economy is on fire. That's why the Fed is raising interest rates. That said, when the Fed is raising interest rates as quickly as it's likely to need to be able to keep inflation down, the scope for large stock market gains are pretty limited. There's some good news, or at least a silver lining here. When the Fed is hiking interest rates, it creates an environment where stock market dips tend to be bigger. So if you're an investor and you have some cash on the sidelines, look for those dips. Those are going to be dips that are worth buying in an otherwise fundamentally healthy economy.
So I have a two-part question for you then, because you mentioned the dips, but could you give us any hints as to where we might find those dips? And then on the flip side, where can we park our money in more safe investments?
Sure, that's a really good question. Let me answer two ways: things to avoid and things to prefer. Things to avoid will be things that don't do well when interest rates are rising, and I'll point out one that has been lagging since November: unprofitable or less profitable software firms. These were the beneficiaries of easy money for the past 10 years. But now that investors are demanding actual free cash flow, these companies have a very long runway to be able to deliver it. I would argue this is the part of the market that's going to see bigger dips, bigger downsides. What's going to hold up better? Things that are that stand to benefit from rising interest rates, especially financials. Banks, insurers benefit from rising rates. Let me give you another one that's protection against inflation: real estate investment trusts. The scope for raising rents, whether you're an e-commerce warehouse owner or an apartment building owner, is really high today. That's going to feed through into higher profits for REITs.
What does this mean for our asset allocations? Is there even a place for bonds in a portfolio in an environment like this?
Sure. So bonds are still an important source of stability, but in a rising rate environment, you want to play defense in bonds. Two ways to do that today. One, own inflation-protected securities. This is by far and away the biggest clear and present danger today in the bond market. By owning TIPS, what you do is you protect your principal against those rising prices, because TIPS, their principal value increases with every sequential increase in the CPI. The faster it goes up, the more you make. The other way that you can protect yourself as a bond investor is by owning lower duration bonds, bonds with less sensitivity to interest rates. So if you're used to buying traditional bond funds, 5 to 10 years out is the typical maturity there. Look for bond funds that are short-term, those that focus on 1 to 5 year maturities. That takes significantly less interest rate risk, is going to hold its principal value much better in a rising rate environment.
It sounds like you guys think GDP will keep on rising.
Sure, I do think that the economy is hot and that it's likely to stay hot. A recession is really a very out of bounds expectation for this year and probably next year too. Here's why. We've just gone through about 24 months of hibernation for the American consumer. We've been stuck at home. We've used some of our excess funds to buy durable goods like cars and refrigerators, but we're chomping at the bit to be able to take a vacation, to go out to dinner more often, to spend money on services. That is really going to give the economy a strong lift because we have the capacity to spend, and now that COVID is in remission, we have the willingness to spend too.
Nice to end on an optimistic note, I guess. Andy Kapyrin, thanks so much for your time. We really appreciate it.